trading strategy for Wells Fargo Securities. I actually park myself on the equity trading floor. I'm not part of research. And I'm just heavily involved in all the day-to-day transactions going on along an equity trading desk. I help traders on certain levels of stocks that they're talking about getting dealt into, etc. And I talk to clients all day long too, giving recommendations and receiving phone calls about, hey Rick, I'm long XYZ, what should I do with it? So I'm there as a resource for essentially everybody. We kind of use the basics of behavioral finance theory at the core of how we look at markets. It's the first step before we ever get down to actually looking at charts. It's trying to take advantage of the inefficiency, shall we say, and the frailty of a human being who has emotional biases, who doesn't usually make good, sound, rational decisions, despite the fact that true economic theory says we do. Behavioral economics realizes that because we're human, we have these biases in kind of unclear ways of acting upon certain information. And when we can recognize them showing up in the marketplace collectively or potentially even individually, we try to take advantage of that. And if we then start looking at models, and if we can see that something's deeply oversold and that the collective reasoning says everything is bad and this will continue going down, if our models suggest that maybe that's not true, we'll often step in and try to buy the proverbial falling knife. But we do so when we think the risk and the reward are really well lined up, and you know, we kind of are counter trend players. So we look to buy what basically nobody wants to own, and we look to sell that everybody just thinks is absolutely going to the moon. I think it's always relevant in the sense that most people, especially a crowd like this at the MTA, if you go to the basic textbooks that we learn this craft from, it'll tell you that the purpose of technical analysis is to identify the trend, to play for the direction of the trend. What I had realized over 20 years ago in my career was that everybody's playing that game. I think the more value added approach to helping people in this game is to be able to identify where the trends are likely to end, when not to be a buyer in an uptrend, when not to be pressing shorts that you've already got on. And I think really when you think about it, the best way for a portfolio manager to outperform over time is to buy stuff near real lows and sell stuff near real highs. If you wait for the evidence to be really there that a bottom's in place, you may be buying a stock 20% above its low. Now you can make money in absolute terms, but my guess is you're not likely going to outperform. If you miss the bottom 20% and you miss the upper 20% because you're not going to sell until it's very clear that a top's in place and now the stock is coming off, that leaves 60%. And my guess is, you know, that's within the first standard deviation of all price activity. Very difficult to outperform over time when you miss the bottom 20 and the upper 20% of the move. I got hooked on this stuff over 30 years ago. I was in college and I was actually charting potato futures when they were still doing potato futures. They're long gone. But I always had a sense that there is rhyme and reason to how markets move. There is a method to the madness. Fundamentals give you a basic backdrop, but we all know at any given time, especially let's use stocks as an example, if an analyst says stock XYZ is worth $60 a share, it easily can be trading 40%, 50% on either side of that because of the rotations in the market and what's going on, as well as the fact that their analysis is not always correct. So using technicals is something that I think is an invaluable tool to understanding market movement. I will always use them, and I will tell you that anybody who really wants to be successful in this business will have, in some level, some shape or form, an understanding on how to read a chart. They may not understand it at the level I do, you do, or people who are technical analysts do, but those people who really succeed understand trend, how to exploit trend, and also how to exploit the ends of trend. I spent several years teaching at NYU, classes on technical analysis and trading classes, and you happen to be fortunate enough to join me. You were in New York when I taught the first course on behavioral economics and finance theory at NYU in the School of Continuing Professional Studies. I haven't taught that in a few years, and it's really just time constraints on me make it very difficult to really give up a night a week to teach. I thought the panel was really terrific. Dave Keller ran a very nicely organized panel discussion also at the end. I like the fact, and this is something I've mentioned many times in prior speeches, that if we collectively as a group are going to have prominence on Wall Street, if we're going to have the respect on Wall Street, then we cannot just get up there and only talk about our victories. We also have to recognize the times we've made mistakes and admit to them. It's part of the game. Nobody expects everybody to always get this game right. There's always been a bad rap on technicians, is that they only remember their good trades and they don't talk about their bad ones. So when Dave essentially asked, well, what's the worst trade you've had for the last year? I thought that was a great question, because all three of us kind of just come out and say, you know, here's where we messed up. Here's where what our analysis, you know, didn't work correct. And I think it's really important as a group that we always present, here's our methodologies, here's what we do, but we don't always get it right. And I think if people continue to present it like that we're always right and we don't talk about those things that didn't work, it's a problem for the reputation of the group. So my favorite part of it was just saying, here, you know, here over the last 6 months, here's 2 trades I just messed up on. In the middle of February, we got our first sell signal in 11 years in gold. We very prominently went out with this, both on TV, to clients, and written work. Gold has come off hard. It just broke down again this morning under 1560. And although it's not, we don't just use an individual horizontal level as if you break, it's a clean break. We have certain methodologies on how something needs to break or break out for us to really believe in it. But if we get a proper break under 1563 on Friday closes, and it cannot happen this week because it's not lined up correct, regardless of where gold closes this week, it's not lined up correctly to get a proper qualified breakdown. But we do think that if we get that, we're talking about $1,400 gold coming out.